Hi guys, welcome to section C, part 1 lectures of Global Finance, which is related to performance management. So as you can see on your screen, performance management section C covers 20% of your score, just like your section B. So 20% again, 500 into 20%, which is nothing but 100 marks of your CMA part 1 exam will come out of performance management. So now what is performance management, sir? See, understand in simple, I'll tell you very short explanation of what is performance management. So if in an organization, as per your budget, you are expected to make a profit of 20 million, whereas the actual profit achieved by the organization for that period is 16 million. So can I say 80% of the target is achieved? So actual target was 20 million, you achieved 80% of that. 20 into 80% is 16 million. So this is nothing but performance measurement. So you're measuring your actual performance as a relative percentage of your budget or your target. This is called performance measurement. Okay. So by measuring this, what are we going to do, sir? We know that we are short by 20%. We are supposed to get 20 million, we got only 16. That means we are short by 4 million. So 20% improvement we need in the profits. So how do we achieve that? To achieve that, first we need to look for the reasons. Why did we not achieve our total target of 20 million dollars of profit? What stopped us at 16 million? What are the reasons? Go into the root cause of it, right? So once you know the reasons why our target was not achieved, then we can look at how do we increase this performance. That is called performance management. So the first step is performance measurement, the next step would be performance management. So without measuring, you cannot manage something. That is why Albert Einstein said a very famous quote, which I also appreciate a lot, that is, something that gets measured will get done. Okay, so basically he said that only things that get measured gets done. Things that get measured and fed back gets done well. So let me just write it on the screen, scribble it here. So things that get measured will get done. Things that get measured plus feedback, this get done better. And things that get paid, I should say, not paid, but for you to easily understand, like when somebody does well, if you give them a little bit of motivation through a bonus. Okay, an employee is performing very well, so if you kind of give him a bonus, then there is more chances that he will perform better in the subsequent period, right? So things that get, I would rather say, motivated will keep increasing further, right? So I do not remember the exact quote as such. I used to remember, but I'm not able to recollect that, but that's fine. So I hope you understood the concept of measurement versus management. So first step is measuring it, second step would be management. And again, to manage, you need to know the reasons and how to overcome those reasons also. Now let me tell you something, sir. What is the first step? Measurement. So to measure, how do we know that? If I ask you, how well is a student performing in the exam? So you will say, sir, based on his score. Okay, based on his score, how do you say? You are comparing that. Comparing with what, sir? Sir, a student scored 80 out of 100. Okay, let me give you a different example. A student scored 80 marks, sir. Is it good or bad? Some people will say, sir, very good, sir. Why? Because you are thinking that 80 is out of 100, which is 80%, which is very good. Sir, but if I say same student got 80, but the exam is out of 500, now this is very bad performance. So to make sure that a performance is calculated, there has to be a base. If that 80 is out of 100, that's very good. If 80 is for 500, that is very bad. That's just 40%. Sorry, how much would that be? 80 out of 500. Okay, my bad. 80 by 500, that's 16%, which is very bad, right? So we need to understand there has to be a base to evaluate or to measure the performance. Now that base in case of business is nothing but budgets, or we can say targets, or we can say standards. All right. So a company prepares a budget, a target, a standard, and then the actuals will be compared with these budgets, targets, and standards. Okay. So this comparison is called variance. So the difference between the target or the budget or the standard and the actuals is called as variance. So first we'll create the budgets or set the standards, then we'll compare them with the actuals, then we'll get the variances. Once we get the variances, we will then look into the reasons for the variances, that is analysis of the variances, and based on those variance analysis, then we'll say that okay, in your company you are supposed to take this particular measure to improve your overall performance, or in your company you have to do this to reduce your cost or to increase your sales or to reduce your expenses. So that we'll do through variance analysis, and then subsequently we'll measure the performance. Then that is your first topic, which is comparison of actuals with the standards. You can see here comparison of actual with standard using flexible budgets. Management by exception is a special case which we'll discuss in the lectures. What are standard cost systems, how do we use them, setting the standards, basically analyzing the variances, basic analysis and advanced analysis, sales volume analysis we'll discuss as a separate topic. Then our second topic of discussion would be responsibility centers and reporting segments. Sir, you know, if suppose there is a company called company XYZ, this has different branches in different countries: country A, country B, country C, country D. 4 branches are there. Now each branch, let's say country A and country B, these two are having separate regional managers. These two entity A and entity B in country and country B, these two have separate regional managers, but entity C and D are managed directly by the head office. Now in this case, all these 4 are different reportable segments, as in all these 4 are different entities, they are separately reported, but A and B are separate responsibility centers. Sir, what do we mean by responsibility? A is the responsibility of regional manager, B is the responsibility of a regional manager. So these regional responsibilities are allocated, that is called responsibility center. Whereas reporting segments means any part of your business which is reported separately is called a reportable segment. Sir, suppose if I take ITC. So ITC company has various products in its portfolio, right? ITC has cigarettes, ITC has Classmate, which is books and stationery. Same ITC also has a Sunfeast, which is into food, biscuits, noodles, MIPA, and all that stuff. ITC is also into oils, right? So you have so many products in ITC. Each of this can be considered as a reporting segment. All right. So that is basically your second topic in section C, which is responsibility centers and reporting segments. And last, you have performance measurement, actual measurement of performance. So here I want you to pay attention to few things. In the performance measurement, we will start with product profitability. Like if suppose Coca-Cola is there. So in Coca-Cola, you have different products. You have Coke, you have Thumbs Up, you have Sprite is there, Maza is there, you have Kinley water, soda. So all these are what's are different products in the Coca-Cola. So out of this, Limca was there. Which product is the most profitable one? Which product is not the most profitable? That is covered under product profitability analysis. Which product is profitable? Which product is not profitable? Then business unit profitability. Like suppose I have 5 different departments, which department is running in profits, which department is running in losses. Suppose I have 3 marketing divisions, which marketing division is performing well, which division is performing badly, where the sales are highest, where the sales are the lowest. That can be covered within your business unit profitability. Then you have customer wise profitability analysis. So some customers you might have more profit, some customers you might get lesser profit. So customer profitability analysis will be there. Next, return on investment, ROI versus residual income, ROI versus residual income, RI. This is a very interesting topic. I'll not be able to explain it here in the introduction. This is numerical calculation, which we'll discuss in the lectures. Then you have KPIs. What are the key indicators? Sir, for example, Hyderabadis are known to be food lovers, right? So if I ask you biryani, what is the best biryani in Hyderabad? I have been giving the same example for the last 6-7 years. So when we talk about biryani, what is the best biryani in Hyderabad, sir? Two names are usually the most popular. One is Bawachi and the other one is Paradise. I know these are not the best ones. Food lovers will immediately be agitated if I say these two are the only ones. You have Shadab. Again, some people like Shadab biryani, some people don't. Personal choice. Then Mehfil is one of my most favorite ones. So you have so many examples. Again, for this example, let's take this 4. So if I ask you to pick the best biryani in Hyderabad, would you consider price? Maybe, may not be. The first factor would be taste, correct? Second factor would be quality. Third factor would be cleanliness, ambience, then price, correct? Maybe in some cases we'll look at the price first and the rest later, but okay, anyways. So if I want to know the best biryani, the most important ones for me would be taste and quality. So here this taste and quality are called as key performance indicators. What is the most critical one? What is the key for your success? And you need to know how to measure them. And then comes my most favorite topic in your entire syllabus, that would be balanced scorecard. So sir, if I ask, is a company that is making 30% net profit after tax every year, is it good or bad? Absolutely good. So 30% net profit after taxes they are making, wonderful, very good. No, I will not say that is very good business. Sir, how, sir? Why is a 30% business very good? Yeah, maybe in terms of profit it is doing good. What about employee satisfaction? What if the employees in that organization are always messed and always pissed off, always angry, always unhappy, always dissatisfied? So can we call this business a success? Maybe in terms of profit you are doing good, but your employees are not at all happy. What about the shareholders of the company? What about the other stakeholders such as government and other stuff? What about your R&D department? Are you doing proper R&D? Last year you made 30% net profit, wonderful, amazing, excellent. Next year one of your competitor came up with an excellent product, nobody is using your product anymore. Your product became outdated. So next year this 30% profit actually became minus 20%. Next year you got a loss of 20. So can you say this profit is doing very good? No. So, and business evaluation cannot be done on the basis of just profits. You cannot just take the profits of the business and say it is doing good or bad, sir. You need to consider various different factors. That is where balanced scorecard will come into picture. Balanced scorecard will tell you 4 different areas or segments to focus upon, and a business performance will be evaluated by paying attention to all the 4 factors, not 1 or 2. So what are those 4 factors? We'll discuss when we go into the classes. All right. So I assume you guys got an understanding of what to expect from section C, what are the topics covered, and I hope you all got a basic introduction to section C of part 1. So I'll see you in the lectures very soon. So until then, keep smiling. Take care. Bye-bye.